You can win 9 trades out of 10 selling options premium and still lose money. That's not a scare tactic, it's arithmetic. And it's the single most misunderstood thing in retail trading. Before we go further, one thing up front. This is educational commentary, not personalized financial advice. Nothing here is a recommendation to buy or sell anything. It's a breakdown of a mechanism so you can think more clearly about your own risk. So why are we talking about this now? Because selling premium has quietly become the most crowded trade in retail. Zero-day options on the S&P now make up a huge share of daily volume, and a big slice of that flow is people selling short-dated puts and call spreads to collect a little income. It feels like printing money. Cash lands in your account every single day. The problem is that the strategy is engineered to feel safe right up until the moment it isn't. Let's define the thing plainly. When you sell premium, you're the insurance company. Someone pays you a small amount today, and in exchange you promise to cover a large loss if the market moves against them. You collect the premium as your revenue. Your job, like any insurer, is to make sure the premiums you collect exceed the claims you eventually pay out. That's the whole game. And the reason it's dangerous is that your revenue is capped and small while your potential claim is large. Here's point 1. The payoff is asymmetric and your brain is not built for it. Say you sell a put spread and collect $30 with a maximum loss of $170. To break even over time, you can afford to be wrong less than 1 time in 6. But because you win so often, your brain records a long streak of green days. Each win feels like skill. What's actually happening is you're being paid small amounts to stand in front of a rare, large loss. The wins are frequent. The losses are severe. Frequency is what you feel. Severity is what kills you. Point 2, the losses are not independent, they cluster. This is the part that turns a bad day into a blown account. When markets crash, 3 things happen at once. The price gaps against you, implied volatility explodes so your positions reprice violently, and correlations go to 1, meaning every short position you hold loses at the same time. On February 5th, 2018, a day traders now call Volmageddon, a popular short volatility product, lost around 90% of its value overnight and was effectively wiped out. People who had safely collected premium for 2 years gave it all back, and more in a matter of hours. That's the core deception. A smooth, rising equity curve makes premium selling look low risk. But smoothness is not the same as safety. A curve that climbs a little every day and then falls off a cliff has the exact risk profile of picking up coins in front of a machine. The smoothness is the bait. It lulls you into sizing bigger because the volatility of your account looks tiny, right until the tail event arrives and the real volatility shows up all at once. Point 3, the strategy actively punishes you for its own success. Win for a few months and your confidence grows. You saw the small max loss and you never came close to it, so you double your size, then you triple it. Position sizing creeps up precisely because nothing bad has happened yet. This is the trap. The longer the quiet period lasts, the larger your position becomes and the larger the eventual loss. The market doesn't blow up the cautious seller. It blows up the seller who got comfortable. Point 4, and this is the one most people never run. Check whether you're even being paid enough. There's a number called the variance risk premium. On average, implied volatility trades a few points above the volatility that actually shows up. That gap is your edge as a seller, and it's real, but it's thin. Historically, it might be worth a few % a year, and it is not constant. When everyone piles in to sell premium, they compete that edge away. You end up selling insurance at a discount, taking the same catastrophic risk for less pay. A disciplined seller asks, is the premium rich relative to what actually happens, or am I just collecting scraps in front of a bulldozer? Let me put a number on the ruin math. Suppose you risk 2% of your account per trade and you win 85% of the time. Sounds bulletproof, but the losses aren't capped at your model's max loss during a gap. In a real crash, a defined risk spread can behave worse than expected on assignment and slippage, and undefined risk positions, like naked puts, can lose many multiples of the premium in a single session. 1 standard deviation move against a position sized for calm markets can erase a year of premium in an afternoon. The recovery math is brutal. Lose 50%, and you need 100% gain just to get back to flat. Now here's the contrarian part, because I'm not telling you premium selling is bad. It isn't. Being the insurer is a legitimate, profitable role in markets. The problem is never the strategy. The problem is the size and the story people tell themselves about it. Sold correctly with respect for the tail, this is a durable edge. Sold the way most retail does it, with creeping size and no plan for the bad day, it's a slow-motion account deletion. So what does a disciplined trader actually do? First, they size for the tail, not the average. They ask what happens on the worst day I can imagine, assume a gap through their strikes, and make sure that day is survivable, not just uncomfortable. Second, they define their risk. No naked, undefined loss positions that can't be bounded. Third, they treat implied volatility as a price signal. They're more willing to sell when premium is genuinely rich and step aside when it's cheap. Fourth, they own tail protection, spending a little of their collected premium on far out-of-the-money hedges. So the crash that ruins everyone else is merely a bad month for them. And fifth, the quiet one, they keep their position size flat even when they're winning. They refuse to let a green streak talk them into leverage, because the entire failure mode of this trade is confidence scaling faster than caution. If you fix your size, you defuse the bomb. The takeaway is simple. Selling premium doesn't feel risky because the risk is hidden in the tail, delayed in time, and disguised by a smooth chart. Your win rate lies to you. Your job isn't to win more often. It's to make sure the loss you know is coming can't take you out of the game. Survival first, edge second. If breaking down the real mechanics behind popular trades is useful to you, subscribe. We do signal, not hype, and we'd rather show you the math than sell you a dream. Trade your own plan, size for the day you hope never comes, and I'll see you in the next one.